Hey everyone, welcome back to the Retirement Roadmap Show. I'm Dave Nagy, and in the studio we have our co-host Tony Shore. And today we're going to talk about something that's been on a lot of minds lately: market volatility.
No.
Yeah.
Buckle up, Buttercup.
Yes.
Yeah, it's been a little volatile this week. I mean, just, a little bit.
A little bit.
But David, thank you for having me on the show. I will say that I've had a better week than the market. I can easily say that this week.
Good for you.
At least, yeah.
Well, that's because you're always so positive.
I try to stay positive.
You're a happy guy.
In fact, as of today, for the first time in like 5 days, the markets are positive. So
Yeah.
yeah. Yeah. So we'll see how that trend, if it continues. I think we're in for a wild ride, maybe even for the
Yeah.
rest of the year, wouldn't you
It's
say?
gonna, I think it's gonna, well, everything that we're seeing right now indicates it's gonna be a bumpy year, but you never know.
Nobody has a
That's
crystal
why,
ball.
yeah, that's why it's the stock market.
Yeah.
If anybody knew for sure, we'd all be sitting at home resting.
Yeah,
Uh,
exactly.
yeah, but
Yeah.
the question I get that a lot, right? Is how do I grow my money without taking on too much risk? And today we're going to talk about growth with guardrails, right? The smarter way to invest in volatile markets. And I really want to share some tools today that we've been using for quite a while now with our clients. And it really helps answer those questions in a big way.
Oh, wow. Good. I'm glad we're going to talk about this because, if I'm getting older or nearing retirement or in retirement, market volatility downturns aren't a good thing. Now, if we're in our working years, people need to not panic because
Yeah.
obviously, you have time on your side. If you have time on your side before retirement, you want the downturn, you want
Yeah.
the market corrections, you want a 10% correction because that allows you to buy low, and the increases after a market correction usually go up higher and hit record highs. So that's the kind of growth we like. However, if you're in retirement, it can be tough. So I'm glad there are
Mhm.
tools out there, and I know you've been using a few. What's the first one you want to talk about that you use with your clients to help kind of hedge against market volatility?
Today we're going to talk about our buffered index portfolios. And no, don't, it's not as complicated as it sounds.
Okay.
Stick with me today.
All right.
But right now, everyone's feeling it. And, you know, I think volatility is healthy no matter where you are in life. We need the market to adjust from time to time. It's
Sure.
it's healthy to
Yeah.
have these ups and downs. But what you mentioned is that as we get older, we don't have time to recover. And so we need to design the portfolio to avoid those downward trends and the volatility and still be able to capitalize on the upside. And that's really the trick today. And lately the market, it kind of feels like a roller coaster a little bit, right? That 2024 was that long climb up, right? Clickety click, everything's going great.
Yeah.
Confidence is high. We're starting to get up there. Finally, it felt like we're in the clear. And then 2025 comes along. We reach the top. You look around, the view's incredible, but then the floor drops out. Your stomach's in your throat, your heart's skipping a beat. Suddenly everything feels uncertain. And here's the thing: if you're one of my clients, you were prepared for the drop.
Right.
And I literally have not had one phone call all month about the volatility. But if you're not prepared, it can be terrifying. And that's really what I want to talk to people today about is being prepared and how we protect our clients from that kind of free fall without giving up the upside. So what if you could invest in a way that captures the growth of the market, but we avoid and minimize the gut wrenching drops? Would that change the way you feel about investing?
Well, sure. Obviously,
Okay.
if you could avoid or minimize the downturn or make sure you protect the principal, right? I think that's a really big thing there. So,
Yeah.
what are we talking about here?
Well, let's talk about current market. right? We've got uncertainty with interest rates. We've got a lot of geopolitical tension.
Yep.
The tech sector has really gotten beat up, and that's where most people were. Most people were invested in tech stocks,
Sure. Yeah, the
and
Magnificent Seven, right?
yeah.
That of the S&P, there's the Magnificent Seven, which is now more like the Pretty Good 10.
Yeah, exactly. And so, like we talked about, if you go back to 2000, 2001, 2002, the market dropped 40%. 2008, again, 40%. We weren't freaking out back then because we had time on our side. In fact, if you're putting money into the 401k, your IRA, your SEPs, you were happy with the market decline. But now, as you get into retirement, you just can't afford that because you don't have the time anymore, right? So we want to look at the market. It has its good days, it has its bad days, but it feels like the bad days are stacking up. And here's the thing, going all to cash isn't a good idea either. And then every once in a while, I get people say, what about gold? What about silver? Look, they're good inflation hedges, but there's better options out there.
Mhm.
And that's where our buffered indexes come into play. And I think, if once you understand how they work, I think most people are really going to like these tools that we use.
Yeah.
So it's one of the tools that we use, and it's exactly what it is. It's something that has a buffer on the way down, but we get the upside of the indexes that we're investing at. So think of it like this. What if you could invest in the stock market, but you had a helmet on and some pads to protect you? When the market goes up, you get 100% of the upside in the growth. But when it drops, there's a built-in cushion we call a buffer. And depending on what we put you into, where you're at with your risk score, where, how much time we're working with, we've got some that have 15% protection if it goes down, 20%, 30%. We even now have some buffers, 100% protection if the market goes down. So you lose nothing. That
Wow.
means no loss in the downside, but upside. Pretty cool, huh?
So this buffered index portfolio, it's crazy. I think that if
Yeah.
you get to participate in at least some of the upside, and you can get even protection, even 100% protection, so no downside, depending on the portfolio and the time. 30%. If it drops, it has to drop below 30. That's huge, right?
Absolutely. And
Yeah.
here's what a lot of people, when I first present these to clients, here's what most people say. Well, this sounds too good to be true,
Yeah.
right?
What's
How
the
can you do
catch?
that? What's the catch?
Yeah.
And that's fair. But look, here's the truth. These tools have been around for a very long time. They're just not talked about much by traditional Wall Street firms. And so, there is a trade-off,
Yep.
right? We're not getting the dividends of the indexes, right? There's terms. So we've got 12-month, 18-month, 24-month. Some of
So
them have,
you're giving up some liquidity,
yep.
and you're going to give up some of the upside. And I've heard some of these have pretty good upside. Like
Oh,
you
yeah.
you make up to, if the market goes up 15%, you get
La-
15%. But if it goes up
Even
20, you don't
more.
get the last 5 or even more, right?
Yeah, right. And we've got some now that are uncapped. You
Wow.
don't give up any of the upside.
Okay.
We had clients last year, they were in a 2-year buffered index. They were 18 months in, they were already up 27%. It had a 30% cap on it. We got them out early. You pay $250 to get out early. So you're really not locked into these things
Oh,
if the
that's great.
market's up.
So
Now,
the surrender charge, or if you do get out of it, it's at least for that particular one that you're talking about. I thought that it would be a lot more costly, but
no,
yeah.
they've always been for the last 5 years, it's $250 to get out early.
Oh, okay. So if you're
That
up 26%, and you put any
It's a
significant amount of
no-brainer.
money at all,
A
yeah,
no-brainer.
that's a no-brainer if you
Yeah.
need to get out at some point.
Now,
And
if the market's down, let's say we're down 20%
yeah,
and you have a 20% buffer, you don't want to get out early because you get out early, you're going to lose 20%,
right.
right? So you're going to want to stay in it for the term if the market's down. But, these can all be tailored to your goals and
Yeah.
risk tolerance. So everyone's different. And I don't want to get too deep into the weeds, but these are phenomenal tools for people that want the upside but can't stomach the downside. So if you're near retirement, or maybe you don't like a lot of risk, you're scared from what happened in 2020 and 2022, you want some predictability, some peace of mind. Look, it's not about timing the market, it's about positioning yourself smartly in the market. So, you know, come into my office, let us show you, let's get to know you, figure out where you should be, and then we'll recommend the different strategies that we employ to help you avoid some of this volatility.
Well, yeah, and there are benefits. This buffered index portfolio sounds like it has a lot of benefits over traditional investing, right?
Oh,
Yeah,
absolutely.
yeah.
Yeah, you're
I
not riding the, you're not just riding the market like you would a roller coaster and hoping it doesn't go off the track, right? You've got guardrails.
There you go.
We're
They're the guardrails you're talking
yeah,
about.
there are
Yeah,
the guardrails, and it's about using them as a foundation based on a broader plan, not the whole portfolio, but we want to make sure that the portfolio is built properly.
yeah. And so I think the best way to proceed, if people have questions about this, or how could I take advantage of this or make it part of my retirement income plan or my investment plan, what do they need to do? It really is catered to each individual. You need to look at their
Yeah.
time horizon, their goals. And so you're offering a no charge consultation, right? There's no charge, no obligation to
No
sit down and go over
obligation.
it.
We went through a lot of information in a short time, but there's just too much to go and unpack all this on the air. So
Sure.
for those of you that want, look, if you're curious, maybe you think it's time to sit down and chat with some, come in, we'll chat, we'll get to know you. Call my office, 619 Go to our website, srswealthmanagement.com. Give us a call. No pressure, no sales pitch, just good information and smart planning.
Awesome. Well, that's what it's all about. And you know what, David? This is a great topic. I'm glad we talked about buffered index portfolios today, getting some guardrails on your plan as you get closer and closer to retirement. And if you're a little risk adverse, this is a great option for you. I think it's fantastic that you have this to help your clients deal with market volatility. And I think it's a great way to address that and not have to worry. Like you say, you're not getting calls from clients panicked when the market has a correction like it had this
Yeah.
past week. So that's fantastic. So again, give that phone number and web address one more time before we go.
Yeah, absolutely, Tony. And you nailed it, right? At the end of the day, my job is to help you grow and protect your wealth, create income that you can't outlive. Plain and simple, we're here to help. So give us a call, 619-460-9433, 619-460-9433, or visit us at srswealthmanagement.com.
All right. Well, David, great show today. Listeners and viewers, that does it for today's episode of the Retirement Roadmap with our host, the man with the plan, David Nagy.